The financial system is being restructured right in front of us, and most people have no idea it's happening. Central banks around the world are making moves that haven't been seen in decades. The IMF just released their October 2025 Global Financial Stability Report, and buried in the technical language is a warning that should make every investor pay attention. They're talking about elevated financial stability risks and stretched asset valuations, while sovereign bond markets are under pressure like we haven't seen since the 2008 crisis. But here's what they're not telling you in plain English. The World Bank's June 2025 Global Economic Prospects Report shows something fascinating. Global growth is slowing, but that's not the interesting part. What's interesting is how central banks are responding. They're not following the old playbook anymore. The crisis-era monetary policies that were supposed to be temporary, they've become permanent features of the financial landscape, and now those chickens are coming home to roost. Think about what happened after 2008. Central banks printed trillions of dollars, euros, yen, and pounds. They told us it was temporary emergency medicine. But here we are in 2025, and not only have they not reversed those policies, they've doubled down. The Federal Reserve's balance sheet, which was under $1 trillion before 2008, exploded to over $9 trillion at its peak. They've trimmed it slightly, but the fundamental structure of the financial system has been permanently altered, and now we're seeing the consequences. The OECD just published their economic outlook, calling for a regulatory reset. That's diplomatic language for the current system isn't working. They're seeing what anyone paying attention can see. The global economy has underlying fragilities that supportive macroeconomic policies can't fix anymore. You can't solve a debt problem with more debt. You can't solve an inflation problem by printing more money. Eventually, reality catches up. Here's where it gets really interesting for gold and silver investors. When the IMF talks about sovereign bond market pressures, they're talking about governments struggling to finance their debt. The United States is running deficits over $2 trillion annually. That's not a typo. $2 trillion every single year added to a national debt that's already over $35 trillion. And we're not alone. Japan's debt to GDP ratio is over 260%. Italy, France, the UK, they're all in similar boats. So what happens when governments can't finance their debt through normal means? They have three options. They can cut spending dramatically, which is political suicide. They can raise taxes massively, which kills economic growth. Or they can do what they've always done throughout history. They debase the currency. That third option is what's happening right now, and it's accelerating. Central banks are caught in an impossible trap. If they raise interest rates to fight inflation, they bankrupt their own governments because the interest payments on all that debt become unsustainable. If they lower rates or keep them artificially low, they fuel more inflation and destroy the purchasing power of their currencies. There's no good option. They're trapped, and they know it. That's why we're seeing something unprecedented in modern history. Central banks are buying gold at a pace we haven't seen in over 50 years. The World Gold Council reported that central banks purchased over 1,000 tons of gold in 2022, the highest level since 1967. And they didn't slow down in 2023 or 2024. If anything, they accelerated. China's central bank has been adding to its gold reserves every single month. Poland more than doubled its gold holdings. Singapore, India, Turkey, Egypt. Central banks around the world are accumulating physical gold like their currencies depend on it. Because they do. These aren't amateur investors making emotional decisions. These are the most sophisticated financial institutions in the world, run by PhD economists with access to data and analysis that you and I will never see. And they're all doing the same thing, converting their paper currency reserves into physical gold. Why? Because they understand what's coming. They understand that the current monetary system, based on unlimited fiat currency creation, is reaching its mathematical limits. You can't have infinite debt in a finite world. Something has to give. The currency reset that financial analysts have been warning about isn't some future theoretical event. It's happening right now, in slow motion, and gold is the escape hatch. Look at what's happening with the BRICS nations, Brazil, Russia, India, China, and South Africa, plus the dozens of other countries now joining or applying to join. They're not just talking about creating an alternative to the dollar-dominated system. They're actively building it. They're settling trade in their own currencies. They're creating alternative payment systems that bypass SWIFT. They're accumulating gold to back their currencies. Russia and China have been particularly aggressive. After Western sanctions froze Russian dollar reserves, every other country in the world learned a valuable lesson. Dollar reserves aren't really yours if someone else can freeze them with the push of a button. That's why we're seeing this massive shift toward gold. You can't freeze gold bars sitting in your own vault. You can't sanction physical metal. The implications for gold and silver prices are staggering. Right now, the paper gold market, the futures contracts traded on the COMEX, is still setting the price. But there's a growing disconnect between paper gold and physical gold. The premiums on physical gold coins and bars have been elevated for years now. Try to buy significant quantities of physical gold, and you'll pay well above the spot price. That spread is telling you something important. There's more demand for physical metal than there is supply. The COMEX has roughly 100 times more paper claims on gold than they have physical gold in their vaults. It's a fractional reserve system, just like banking. It works fine as long as everyone doesn't ask for their gold at the same time. But what happens when they do? We're starting to find out. Major investors and institutions are increasingly taking physical delivery instead of just trading paper contracts. That's putting pressure on the system. The London Bullion Market Association, which handles the majority of global gold trading, has seen similar pressures. Physical gold is moving from west to east at an unprecedented rate. It's leaving the vaults in London and New York and ending up in Shanghai, Singapore, and Dubai. This is a one-way flow. That gold isn't coming back. Now let's talk about silver, because silver might be even more interesting than gold right now. Silver has this unique dual nature. It's a monetary metal like gold, with thousands of years of history as money. But it's also an industrial metal, and that industrial demand is exploding. Solar panels use silver. Electric vehicles use significantly more silver than traditional cars. 5G infrastructure, medical devices, water purification. Silver is essential to the modern technological economy. The Silver Institute estimates that industrial demand for silver is at all-time highs and growing. But here's the problem. We're not mining enough silver to meet that demand. For years now, the world has been consuming more silver than it produces. The deficit is being made up by above-ground stockpiles, but those stockpiles are finite and shrinking. At some point, probably sooner than most people think, we're going to hit a supply crunch in silver that makes the current situation look tame. And when that happens, the price is going to do things that seem impossible right now. Think about this. Silver is still trading well below its inflation-adjusted all-time high from 1980. Back then, silver briefly touched $50 an ounce. Adjusted for inflation, that's over $180 in today's money. Silver is currently trading around $25 to $30. That's an 85% discount from its inflation-adjusted peak. Does that make sense for a metal that's more essential to the modern economy than it was in 1980? A metal that's being consumed in industrial applications at record rates? A metal that central banks and investors are starting to accumulate alongside gold? The gold-to-silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, has been historically around 15 to 1. That's the ratio you find in the Earth's crust. That's roughly the ratio that prevailed for most of human history. Right now, that ratio is around 80 to 1. Silver is historically cheap compared to gold. When that ratio reverts to its historical mean, and it will, because these things always revert eventually, silver is either going to explode higher or gold is going to collapse. Given everything we've discussed about central bank gold buying and the currency reset underway, which scenario seems more likely? Here's something else most people don't understand about the precious metals market. The suppression mechanisms that have kept prices artificially low are breaking down. For years, large banks have been caught manipulating the gold and silver markets. JP Morgan paid nearly $1 billion in fines for spoofing the precious metals markets. Deutsche Bank, HSBC, UBS. They've all been caught and fined for manipulating these markets. The manipulation was real, it was systematic, and it was designed to keep prices lower than they would naturally be. But here's the thing about manipulation. It only works until it doesn't. You can hold a beach ball underwater, but eventually your arms get tired. The natural forces of supply and demand are stronger than any manipulation scheme, given enough time. We're seeing those natural forces reassert themselves now. The physical market is overwhelming the paper market. Real demand from central banks, institutions, and individual investors around the world is exceeding the ability of the paper markets to suppress prices. Quick aside here. If you're sitting on $100,000 or more in retirement accounts, I put together a free guide on how gold IRAs work. It's in the description. Covers how to get physical gold into your retirement account without tax penalties, which is something a lot of people don't realize is possible. Worth checking out if that's relevant to your situation. Anyway, back to where this is all heading. The World Bank's report mentions something crucial: high public debt combined with slowing growth. That's a toxic combination. When economies are growing, you can theoretically grow your way out of debt. Tax revenues increase, the debt to GDP ratio improves, and everything works out. But when growth slows while debt keeps increasing, you're in a debt spiral. The math doesn't work anymore. And that's exactly where we are globally. The United States, Europe, Japan, China, all the major economies are dealing with this same problem. Too much debt, not enough growth. And the traditional solutions aren't working anymore. You can't cut interest rates much further when they're already near zero. You can't do more quantitative easing without triggering runaway inflation. You can't increase government spending when you're already running massive deficits. So what's the solution? Historically, when governments get into this situation, they reset the monetary system. They revalue their currencies, often against gold. They restructure debt. They create a new framework that allows them to start fresh. It's happened many times throughout history. It happened in 1933 when FDR confiscated gold and revalued the dollar. It happened in 1971 when Nixon closed the gold window and ended the Bretton Woods system. It's going to happen again. The only question is what form it takes and when. Some analysts think we'll see a new Bretton Woods-style agreement where major countries come together and create a new international monetary system, possibly with some gold backing. Others think it will be more chaotic, with different currency blocks forming and competing. The BRICS nations might create their own gold-backed currency. The dollar might lose its reserve status gradually, then suddenly. Whatever form it takes, gold and silver will be at the center of it. They always are when monetary systems reset, because they're the only forms of money that can't be printed, that have no counterparty risk, that have maintained value for thousands of years. Think about what happened in 1971. Before Nixon closed the gold window, gold was $35 an ounce. By 1980, it had risen to over $800. That's a 1,200% increase in less than a decade. Silver went from $1.50 to $50, a 3,200% increase. Those weren't normal market moves. Those were monetary reset moves. That's what happens when the underlying monetary system changes and people rush to protect their wealth. We're seeing the early stages of a similar move right now. Gold has been making new all-time highs. Silver has been consolidating, building energy for its next move. The fundamentals are even stronger than they were in the 1970s. The debt levels are higher. The currency debasement is more extreme. The geopolitical tensions are more severe. And this time there's a new factor: the rise of Asia as an economic power. In the 1970s, the gold and silver bull market was primarily driven by Western investors and Middle Eastern oil money. Today, we have billions of people in China, India, and Southeast Asia who are entering the middle class and have a cultural affinity for gold and silver. They don't trust paper currencies the way Westerners do. They want physical metal. That demand is structural and permanent. It's not going away. If anything, it's accelerating as these economies grow, and more people have disposable income to invest in precious metals. The supply side of the equation is equally compelling. Gold production has been essentially flat for years. The easy gold has been mined. New discoveries are rare and expensive to develop. It takes 7 to 10 years to bring a new gold mine into production. And that's if you can get the permits and financing, which is increasingly difficult. Silver production is even more constrained because most silver comes as a byproduct of other mining operations. About 70% of silver production comes from mines that are primarily producing copper, lead, or zinc. So silver supply is dependent on the economics of those other metals. You can't just decide to produce more silver because the price is rising. It doesn't work that way. Meanwhile, demand for both metals is increasing from multiple directions simultaneously. central banks buying gold, industrial demand for silver, investment demand from individuals and institutions, jewelry demand from Asia. It's a perfect storm of supply constraints and demand growth. The paper markets are trying to keep a lid on prices, but they're fighting a losing battle. Every time they push prices down, physical buyers step in and take delivery. The disconnect between paper and physical is growing. At some point, that disconnect becomes so large that the paper market loses credibility entirely, and price discovery shifts to the physical market. When that happens, prices are going to gap higher in a way that will shock people who aren't paying attention. Look at what happened in March 2020 during the COVID panic. The paper price of gold and silver crashed, but try to buy physical metal at those prices. You couldn't. Dealers were sold out. Premiums exploded. The U.S. Mint stopped producing coins because they couldn't get blanks. The disconnect between paper and physical was so extreme that it nearly broke the market. That was a preview of what's coming, except next time it won't be a temporary panic. It will be a permanent shift as the monetary system resets, and people realize that paper claims on gold and silver aren't the same as physical metal in your possession. The COMEX and LBMA have been able to maintain control of price discovery because most participants are happy to trade paper contracts. They don't want physical delivery. They're just speculating on price movements. But as more participants demand physical delivery, as more investors realize that paper gold isn't the same as real gold, the system is going to be tested in ways it hasn't been before. There are already signs of stress. The COMEX has changed its rules multiple times to make it harder to take delivery. They've increased margin requirements. They've created new contract specifications. These are the actions of an exchange that's worried about its ability to deliver physical metal if too many people ask for it. The same thing is happening in London. The LBMA has been quietly tightening its rules around physical delivery. They're making it more expensive and more difficult to take metal out of the system. Why would they do that if there was plenty of physical gold available? The answer is obvious. There isn't plenty of physical gold available. The vaults are being drained. The metal is moving east. And the Western financial institutions that have controlled the gold market for decades are losing that control. This is a historic shift, and it's happening right now. The monetary system that has existed since 1971, a pure fiat system with no gold backing whatsoever, is reaching its end stage. The debt levels are unsustainable. The currency debasement is accelerating. The loss of confidence in paper currencies is spreading. Gold and silver are reasserting themselves as real money, as they always do when fiat currencies fail. It's not a matter of if, it's a matter of when and how fast. The smart money is already positioned. Central banks have been accumulating for years. Billionaire investors like Ray Dalio have been vocal about the need to own gold. Institutional investors are adding precious metals to their portfolios. The trend is clear. The question is, are you positioned for what's coming? Because when this reset accelerates, and it is accelerating, there won't be time to react. The moves will be too fast. The premiums on physical metal will be too high. The availability will be too limited. The time to prepare is now, while prices are still reasonable, while physical metal is still available, while most people are still asleep to what's happening. The countdown to the reset isn't some distant future event. It's happening right now, and it's accelerating fast. The signs are everywhere if you know where to look. Central bank gold buying, currency debasement, geopolitical tensions, supply constraints, growing demand, paper market stress. All the pieces are in place. The question isn't whether the reset is coming. The question is whether you'll be ready when it does.